Inflation is a persistent force in the world of economics, shaping the financial landscape and impacting individuals, businesses, and economies at large. In this video, we will delve into the concept of inflation, examine its effects on purchasing power, and explore strategies for protecting and growing wealth in an inflationary environment. One, understanding inflation. Inflation, often referred to as the silent eroder, is a pervasive economic force that can subtly erode the value of your money over time. It represents the gradual increase in the prices of goods and services, leading to a decline in the purchasing power of your currency. What this means is that with each passing year, the same amount of money can purchase less than it could in the past. This phenomenon has profound implications for personal finances, investments, and long-term financial goals. To safeguard and grow your wealth effectively in the face of inflation, it is essential to understand the causes and consequences of inflation and employ strategies that mitigate its impact on your financial well-being. 2. The effects of inflation on purchasing power. The effects of inflation on purchasing power are far-reaching and can significantly impact the financial well-being of individuals and households. As prices rise over time, the real value of a currency diminishes, meaning that the same amount of money can buy fewer goods and services. This has profound implications for consumers, as it erodes the purchasing power of their earnings and savings. For retirees on fixed incomes, inflation can gradually reduce their standard of living. It also affects long-term financial goals, like saving for education or retirement, as the future purchasing power of those savings is diminished. Savvy financial planning and investment strategies are essential to combat the erosion of purchasing power and secure one's financial future in an inflationary environment. 3. Strategies for protecting wealth in an inflationary environment. Invest in inflation-resistant assets. Investing in inflation-resistant assets is a prudent strategy for safeguarding your wealth in an inflationary environment. These assets have the potential to retain or increase in value as prices rise, effectively acting as a hedge against the eroding power of inflation. Real assets like real estate and commodities, such as gold and silver, are often sought after during inflationary periods due to their intrinsic value. Real estate can appreciate over time and generate rental income, making it a popular choice for investors. Precious metals like gold and silver have historically preserved value in times of economic uncertainty. By incorporating such assets into your investment portfolio, you can help maintain the real value of your wealth and mitigate the adverse effects of inflation on your financial well-being. Diversify your investment portfolio. Diversifying your investment portfolio is a fundamental strategy for mitigating risk and preserving wealth in an inflationary environment. By spreading your investments across various asset classes, such as stocks, bonds, real estate, and alternative investments, you reduce your exposure to the potential impact of inflation on any single asset. Stocks can offer growth potential, bonds provide stability, and real estate can act as an inflation hedge, while alternative investments like hedge funds or commodities add another layer of diversification. This approach helps ensure that if one segment of your portfolio underperforms during inflation, others may offset the losses or even provide gains. Diversification is a key risk management tool, as it helps protect your wealth from the eroding effects of inflation and enhances the overall resilience of your investment portfolio. Invest in Treasury inflation-protected securities. Investing in Treasury inflation-protected securities is a direct and reliable way to protect your wealth from the corrosive effects of inflation. TPIs are U.S. government bonds designed explicitly to guard against the eroding power of rising prices. They work by adjusting their principal value with changes in the Consumer Price Index, a widely recognized measure of inflation. As inflation rises, the principal value of TPIs increases, ensuring that the real value of your investment keeps pace with the cost of living. Additionally, TPIs pay interest semi-annually, providing a consistent income stream. This makes them an attractive option for conservative investors looking to preserve their purchasing power while minimizing risk, especially in times of economic uncertainty or inflationary pressures. Regularly review and update financial goals. In an environment marked by inflation, Regularly reviewing and updating your financial goals becomes not just a wise practice, but a necessity. Inflation can subtly alter the financial landscape, eroding the purchasing power of your savings and influencing the cost of your long-term objectives. Whether you're saving for a comfortable retirement, your child's education, or a major purchase, the impact of inflation must be factored into your planning. Regular reviews allow you to assess whether your financial goals remain realistic and attainable, considering the rising cost of living. It also enables you to adjust your savings and investment strategies to ensure that your financial objectives are not compromised by the gradual erosion of the value of money. By staying proactive and adaptable in your financial planning, you can navigate the challenges of inflation while working toward your long-term financial aspirations. 5. Preparing for an uncertain future. Preparing for an uncertain financial future, particularly in the face of inflation, is a matter of prudence and foresight. Recognizing that economic conditions can evolve and the value of money can erode over time, it is essential to adopt a proactive stance. This entails continually educating yourself about economic trends, reviewing and adjusting your investment portfolio, and remaining adaptable to changes in your financial landscape. It means seeking professional financial advice when necessary and being diligent in assessing your progress towards your goals. By taking these steps, you can better secure your financial future, protect your wealth from the insidious effects of inflation, and ensure that you are well prepared for whatever economic uncertainties may come your way. The role of central banks and monetary policy. The role of central banks and their monetary policies holds significant sway over inflation. Central banks, such as the Federal Reserve in the United States, use a range of tools to influence the money supply and, by extension, inflation rates. These tools may include setting interest rates, engaging in quantitative easing, and managing the money supply. When inflation rises too rapidly, central banks may enact contractionary policies, such as raising interest rates, to curb spending and slow the economy. In contrast, during periods of economic downturn or low inflation, central banks may implement expansionary measures, like lowering interest rates or buying government bonds to stimulate economic growth. Understanding the role of central banks and their monetary policy decisions is crucial for investors and individuals alike, as these policies can significantly impact both short-term and long-term financial planning. Inflation and debt management. Inflation and debt management are intricately linked, and the relationship between them can affect individuals and businesses in various ways. One of the key impacts of inflation on debt is that it can erode the real value of outstanding loans. Inflation effectively reduces the purchasing power of a given amount of money, making it easier for borrowers to repay fixed dollar debts over time. However, the converse is also true. If your income doesn't keep pace with inflation, servicing debt may become more burdensome. For individuals and businesses, strategic debt management becomes crucial in an inflationary environment. It's important to consider whether to take on new debt, how to structure loans, and how to balance the benefits of debt repayment with the potential effects of inflation on the real value of debt. Each individual's financial situation is unique, and a tailored approach to debt management is essential in navigating the complex interplay between inflation and liabilities. Building a robust financial plan for inflation. Building a robust financial plan for an inflationary environment is an essential step in securing your long-term financial well-being. Such a plan should encompass a range of strategies and considerations, including investment diversification, allocation to inflation-resistant assets, and a regular review of financial goals. Additionally, it should factor in the potential effects of inflation on both savings and liabilities. Tailoring your financial plan to align with the ever-evolving economic landscape is crucial, and it may require the expertise of financial advisors. A well-structured plan that anticipates and adapts to inflation will not only help preserve your wealth, but also facilitate your journey towards achieving important financial goals, such as retirement or education funding, despite the persistent force of inflation. That's an end for today's video. What are your thoughts on this? Let us know in the comments down below, and make sure to like and subscribe to our channel.